Hi, I'm Mark Draper. Joining me today is Felicity Laundy, and we're talking about Australian interest rates, which are among, at the moment, the highest in the world.
Mark, where do you think interest rates are going next?
Well, Bill Evans from Westpac's been very vocal about this for some time. He thinks they're going down as the next move. We agree. We're going to show you a chart on your screen now, which is what the market's pricing into interest rates. So you'll see the left-hand side is the cash rate, and the right-hand side is the mortgage rate, and the bottom axis is the time between now and 2013. So what you can see is that the market is pricing in somewhere between 5 and 6/4% rate movements down. So that's between now and the middle of the next year. So that means interest rates are being priced to be reduced by somewhere between 1.25% and 1.5% between now and the middle of next year.
Why do you think the market is pricing in lower interest rates?
Yeah, Fliss, the main reasons are that outside of the mining sector in Australia, the rest of business is actually doing it pretty tough. You know, you're seeing very difficult conditions in the retail sector. Housing construction is very poor, and credit growth or new lending growth is at recessionary lows. And I think add to that unemployment starting to rise, which is likely to continue for the duration of this year.
Yep.
I think these are all the factors that are likely to influence the Reserve Bank in cutting rates.
Okay. So what will this mean to people?
Well, I think what it means obviously to the mortgage owners of Australia is that they're going to get a cut in interest rates, which is going to cut their repayments.
Sure. What about retail? Will it impact on them at all?
Well, I think the impact on retailers is that if there's less money going to service mortgages, there's more money for people to spend. And this was evident back in 2008, where the last time interest rates got cut, there was a big surge in retail spending as a result of that. And I think the other aspects that are likely to benefit from this is it's likely to be good for share markets and property markets. Simply because the income that people can get from property investments and share investments relative to interest rates from term deposits and cash is likely to be a lot more attractive.
What about cash and term deposit investors?
Yeah, well, look, I think the real negative of interest rates going down is those investors who are in cash and term deposits. And if the markets are right in saying that we're likely to see interest rates going down by 1.25% to 1.5%, then that effectively means a 25% reduction in income for cash and term deposit investors. So I think they're the people who are going to hurt from this.
Okay.